But let's get the technical read on the stock with BofA Securities Head of FIC and Equity Technical Research, Paul Ciana. Paul, it's great to have you on the show. Welcome.
Thank you, Morgan. Great to be here.
So let's start right there with what you're seeing in NVIDIA and the semis right now, and then we'll expand.
Sure. I got to tell you, we took over Equity Technical Outlook for BofA this year, and we initiated a cyclical bear market call for the S&P 500 and equities. And NVIDIA fits right into that basket of, rolling over with a technical top pattern and starting a cyclical bear market. I think what's interesting is, of all the cyclical bear markets for NVIDIA, except 2008, every decline was more than 50% in the stock price, and we're not there yet.
So what does that tell us then about where we move from here? Because I feel like it's as go the semis, and particularly NVIDIA, which has been so oversized in this market, so goes the broader market. What are the warning signs then?
Well, I think one way to think about NVIDIA is recall back in May 2024, all the hype and all the mania around semiconductors and NVIDIA being the next best thing since sliced bread. And it announced a 10-for-1 stock split when it was trading at about $950 a share. Therefore, it's split back now to about 95, which is almost where we're trading once again. So I think for a stock like NVIDIA, the market tends to suss out pain in positions. And there's long-term longs that maybe under pressure to exit, especially if we're kind of crossing below that threshold again.
So how does that funnel into what you're seeing in the XLK and how that compares to the broader S&P?
Yeah, so XLK, a technology ETF, one of the members, of course, is NVIDIA and many others. What we're seeing in XLK versus the S&P 500 is what's called a head and shoulders top pattern that suggests the XLK underperforms the S&P 500, or tech stocks underperform the broader basket of the S&P 500. Thus, there can still be weakness in that, Mag 7 tech-heavy sector out there.
This death cross in the S&P 500, how much to make of it?
There is something to make for it. Death cross on the S&P, death cross on the dollar index. There's always a moving average cross somewhere. But yes, one of the popular ones certainly is the death cross on the S&P. I think what we need to take into account here is the fact that the 200-day moving average had a declining slope this time, which does give the signal a bit more efficacy. Given, the long-term history, it does suggest that the next 20 or so trading days can be weaker and statistically relevant, weaker before the S&P 500 can actually find some sort of bottom. Now, I think that's interesting because we went back and did a study of a number of the different flash crashes and sharp declines. And more often than not, the S&P retests that flash crash low or makes a modest new low. So we're still tactically bearish the S&P 500 here, thinking the lows this year are tested, if not broken, and that rising 200-week moving average approaching 4,700 is likely reached. So we're kind of playing it tactically bearish after this death cross because that 200-day moving average was declining.
You just mentioned the dollar index. We had Joyce Chang from JP Morgan on earlier in the show, and she was talking about the outperformance of the euro and how it's been behaving as something of a safe haven. It looks like you've done some technical work on the euro, too.
Yes, we absolutely have. I think we've done a lot of technical work on the euro. I think one of the most interesting ways to look at the euro is how it tends to V-bottom in a very sharp manner and rebound in an equally aggressive manner. And we've seen this, 12, 15 times since the peak in 2008, and the euro's been in that secular decline ever since. And that trend line that's been guiding it lower since 2008 is actually breaking this month. It's a huge potential breakout for the euro this month that does confirm a bias that we could see 120 within a year's time.